Introduce you to Fernando Vaquero. I've already talked about his resume in the introduction, so I will not repeat it. You have some information, or actually, you don't have information about Fernando Vaquero in your folder, so I will tell you that he's a JD and accountant from the University of Buenos Aires, and LLM from the Tela University in Buenos Aires. He's a co-author of the book International Taxation, which was awarded as the best book of the year by the Argentine Association of Fiscal Studies, and he's a senior associate at Mairal, one of the most prestigious firms in Latin America. We have also Gabriel Mesa. Please refer to your booklet for his resume information. We are very happy to have him here with us. He's from Cleary, Gottlieb. And we have Kingsley from Forum Asset Management. He's an alumni from Duke, and we are very happy to have you here. Thank you very much, gentlemen. Fernando Vaquero will start, and then we will continue. Thank you.
I think you're first.
We will make a slight change in the schedule, as you have seen today. And could you start, Gordon?
Yeah, sure. Yeah, happy to do that. Yeah, no problem at all.
Oh, you have also. Oh yeah, no. You also have. Excuse me. You also have a PowerPoint, and I'm missing the PowerPoint guy. I will be solving that in.
I don't actually. I could go because I don't have PowerPoint.
It's the old-fashioned way. It's much better.
I'm unprepared, so I should pay the penalty. Thank you. I think program has me talking about private equity. I am primarily an M&A lawyer who works mostly in emerging markets, including in Latin America. And I would probably say mostly in Latin America, doing both, I think, private equity type investments as well as strategic transactions, strategic sales. And my thought was to talk a little bit today about the history of private equity investment in Latin America, because I think it's actually quite interesting and enlightening, especially for folks who are younger, because it demonstrates a lot, I think, some of the volatility of investment in the region, and carries, I think, some kind of interesting cautionary tales about it. I started Cleary in 1994, and I think you could say that private equity investment in the region dates from about 1993. So I think my career has sort of been coterminous with the beginning of the private equity investment. You could talk about private equity investments as having really two, I would call them as two waves of investment. I mean, the first one that went from about 1993 to about the year 2000, I think to about the year 2001. The second one of which began 2004, 2005, and continues today. And it's really a story of a rise and a fall and a rise, because I think that the investments that began in 1993 started out quite optimistically and ended up rather poorly in the 2001, 2002. And then there's been kind of a renaissance of private equity in the last few years. And one thing I wanted to touch on is really some of the changes that have happened in terms of the private equity investments, and what lessons I think were learned from the first wave of investments that are causing, hopefully, this wave to continue and not crash the way that the first one did. The investments that began, I think, in 1993, what I would call the first wave of investments, really tried to mimic as much as possible the way that private equity investments were being done in the United States. I mean, the characteristics that had made private equity investments successful in the U.S., the idea was to try to adapt them as much as possible to the local model. Just going through those, very quickly. Do them quickly. The idea behind private equity, for those of you that are not necessarily that familiar, private equity or private equity funds, I mean, they're investment vehicles that pull money from outside investors and make investments in the medium term through privately negotiated contracts. And the way that they make money is really by exiting within a certain period of time. I mean, typically they have an investment horizon of, it varies, I guess, but 3 to 6 years. It's been sometimes longer, I think, in Latin America. And I'm actually going to concentrate a little bit on exit because I think that's, to my mind, some more interesting issues that have happened and that caused, I think, the collapse of the first wave of investments really had to do with the ability to exit from those investments. The idea, I think, the paradigmatic, I think, private equity case is one in which the investor takes a minority participation in a privately held company. In Latin America, these were typically family-owned companies, for the most part. They take a minority participation. They team up with the local owner, the local shareholder. They exercise control, it was called the negative fashion, that is by being able to block decisions at the board or shareholder level and thereby control the investment. They attempt to exit, like I said, within a certain period of time. Usually the investment tries to take the form of some type of preferred instrument, primarily to have both to have potentially a dividend that is payable currently, as well as to have seniority over the common equity in case of a liquidation, kind of a worst case type scenario. And the exit in the United States has typically been accomplished more often than not through IPOs. As we know, IPOs tend to be very profitable and tended to be, certainly at the time that we're talking about, carried a significant multiple to other types of investment, including what are called trade sales, which are being able to sell to somebody else who might come, such as a strategic player or another party who might come in and buy you out. I think at the time, I think IPOs had something like were 4 times as the valuation was really 4 times as high by doing an IPO than by doing a trade sale. So there was a lot of incentive of really trying to do an IPO. And I think people certainly had in their minds, back during the first wave of investments in private equity in Latin America, that they could try to exit through IPOs, which proved to be rather delusional. And yet, you spent a lot of time really negotiating the equivalent of what you would have done in the United States, which are registration rights agreements with demand rights and piggyback rights, which are, if you're not familiar with them, I won't go into too much detail, but they're essentially ways of being able to place your shares and have the company register them in the case of an IPO, and in certain cases even being able to force the company to do an IPO. Sometimes I think as well, in terms of the exit rights, I think IPO is viewed as the most desirable, followed by a potential trade sale, in particular a sale to a strategic player, followed by potentially the right to have your shares, your preferred shares redeemed, or the right to put your shares to somebody, most likely your local partner. But I think these were almost viewed as things that you would do if you were not able to do anything else, if you were really not able to make the company public, or if you were not able to sell out to a third party. You kind of had these options. These exit rights did not work, I think, quite as expected. I mean, the market for IPOs just never quite materialized the way that I think the first wave of investors hoped. There was an expectation, I think, because of some original successful 144A and registered deals that had been done in the U.S. with Latin American equities, that this would be a trend that would follow. But in the United States, I think the market soured. It has been sour for Latin American equities for some time. And locally, at the time, the markets really were not, the capital markets in each of these countries were really not as developed as people expected, and they did not develop within the same sort of time frame as the time frame that was required to exit the investments. And I think the peculiarities I think of also Latin America itself and the legal systems there made exiting in other manners not as possible, not as easy to do as you could have done in the United States. I mean, the idea of a trade sale, for example, which involves, or a strategic sale, which involves selling out to some strategic party. Well, you can't really do that unless you control the company, right? I mean, one significant difference between the private equity investor and the strategic investor. The strategic investor is going to really be looking for control of the company. The private equity investor doesn't have it. All he has is a 15%, 20%, 25% interest in a company. How do they interest the strategic investor in this? I mean, the typical way that that's done, I mean, sort of the easy answer, is that, you know, people negotiate rights in shareholder agreements, including what's typically called in the a drag-along right, which would allow you to drag along your partner in the event that you get an offer for 100% of the company, which is a very valuable right, but it also has to be an enforceable right. And I think people found, I think it's one of these things, you know, when you negotiate these shareholder agreements, people sort of forget, but you know, these are agreements that you often use when you have an issue, when you have a problem, when your partner doesn't want to do what you want them to do. And that's when you start looking at this and figuring out what your rights are. If your partner wants to sell out to the strategic investor the way you do, everything's hunky-dory, everybody's happy. If your partner doesn't and you invoke the right, that's when you have the issue. And I think there were real concerns in Latin America about the enforceability of shareholder agreements generally, mostly about voting rights and agreements to vote in a lot of these documents. But as well, with respect to the ability to transfer. In particular, it was very difficult in Latin America, and remains still very difficult, to obtain specific performance for breach, and which is the sort of thing that is very valuable to you. If you come to a situation where you have a strategic investor saying, I'd like to buy 100% of your company, you've got 25, but can you drag your partner? Well, my partner doesn't want to sell. Well, do you have a right that would compel him to sell? Oh, sure I do. Well, use it. You go to your partner and you say, well, the agreement says you have to sell. So, well, I don't want to. So what do? And there are jurisdictions where you can go, and including, hopefully, including the United States, although I think you still have to have some hurdles here in terms of showing specific performance. But if you really can't get specific performance for this, in a sense, you're really out of luck. Because what you're left with is to say, suing, and suing for damages, right? And suing for damages in a jurisdiction where your litigation and your time to get a judgment in litigation is likely to exceed your time to exit. Right? I mean, if you have an exit that says 3 to 5 years, but you got a litigation that's taken 10 years, that's really not an option. And it's also not an option to get damages when what you really want to do is to sell to the strategic player who's not going to wait around for 10 years until some sort of judgment is obtained. So I think people found that these things worked well if your partner wanted to go along with you, and if your partner didn't want to go along with you, you really didn't have all that many options. You had a lot of issues as well with things like puts and things like you know, the redemption of your shares, because I think redemption of shares was always particularly complicated, because I think there are, and I won't go into all the details, but I think there were a lot of issues, I think, in Latin America with respect to the ability to redeem. In some countries it wasn't able to be done. In other cases, it could only be done pro rata to all the shares held by all the shareholders. That was particularly tricky. But even putting aside the legal issue of being able to get the redemption, there was also the question as to whether and I think people didn't really think about it. It's sort of thing like you think, in retrospect, why didn't people think about this? But I mean, the reason why private equity was attractive for local players, for some of these families who own these businesses, was because there really was not such an active credit market as there is today. It was hard to borrow. And if you needed to do a capital expansion, if you needed to grow your business, there really were not necessarily so many options available. Some of the options were quite expensive. So getting in a private equity investor was viewed as attractive. So but think of the situation. You put in $100 million, your private equity investor puts in $50 million into your company, right? Has shares, can't do the IPO, can't sell to a strategic, it decides to do the redemption, or it decides to put. And it does, but you've put in $50 million into the company's gone out and invested it in capital expenditures. Where the heck are you going to get your $50 million back from? I mean, in the United States, you would borrow, but that's exactly the point. The company didn't have the money to borrow. If the company had the money to borrow, it would never have asked you to invest in the first place. So you're often left with these rights which have become kind of meaningless. I mean, they look very nice on paper, but in reality, the person says, you want to put this to me? Fine, put it to me. Or have me redeem it. You know what? When I have money, I'll pay you. It's not a very attractive situation. And then I think what really put the more serious situation was in January of 2002. You started having macroeconomic problems in 1999 with the Brazilian devaluation. And then the Argentine economic crisis, which in 2002 led to the devaluation of the peso. And at the time, Argentina was really one of the most popular and attractive countries for private equity investment, particularly in tech stocks, which at the same time were suffering an implosion here. The company was attractive for a number of reasons, not the least of which was the fact that it had parity between the dollar and the peso, and that by law you could walk into any bank in the country and deliver your pesos and obtain dollars in return. I mean, obviously, for obvious reasons, repatriation, the ability to repatriate and the ability to preserve the value of the currency is of utmost concern and utmost importance to a private equity investor. So Argentina was really one of the preferred markets, and when the devaluation hit, I mean, a lot of people lost their shirts. I mean, Hicks Muse, one of the largest, funds, had to, close down shop in the region. I think other funds went under, and I think that signal event, I think, led to a real drying up of interest in private equity for some years. What the new, I think, there's been, with the new wave of investment, I think a few interesting things have happened. I think in particular a few interesting things have happened in terms of the ability to exit. I think with respect to the first wave, there was some interesting numbers. I mean, in 2003, because I went back and sort of looked through I'm a pack rat, I never threw anything out. I had all these articles from this time, which was kind of interesting to look through. There was an article I recall mentioned between 1995 and 2000, out of 227 investments, only 15 investments had been exited, which is kind of an astounding number. And in 2004, of 27 exits, only 5 were IPOs, which is clearly very different from, I think, what people were expecting at the time that they made these investments. And I think the crash after, because of Argentina, I think was really quite serious. I think this is a kind of a sobering statistic. If you look at the one-year rate of return on private equity investments today, right, looking back, that number is 31%. Okay, it's a very high number. If you look over a 3-year horizon, it's 14%. It's probably better than my mutual fund, but it's not exactly what private equity investors are looking for. It's not so good. If you look at 5-year return, it's minus 6.1%. If you look at the 10-year return on private equity investments in Latin America, it's minus 3.2%, which is interesting because it sort of tells you, if you really look back historically over a 10-year period, private equity investments have lost money. Right? So they're making money now, but I mean, if you really are going to look at this with hindsight, it has not been a profitable endeavor by any means. What are probably taking up all my time now? I haven't really looked at the. Oh, okay, well, all right. Not doing so poorly. What is different now, I think, about the second wave of investment? I think people are a lot more savvy. I specifically did not talk about issues relating to control or diligence and so on because I think I wouldn't have time. But certainly there were issues there as well, and I think one way that people are dealing with issues that they encountered at private equity funds is really to be a lot more proactive and a lot more involved. I think they have learned to have people on the ground. They have learned to have people who have a lot more knowledge, I think, about the region and the investments. And as a result, they're not necessarily taking any longer, I mean, they are taking minority participations, but they're now willing to, and in some cases quite desirous of taking controlling interest, which was something that would have been really anathema in 1993 or 1994. That was just nothing that they did because the view was, I'm going to partner with management. Management is my local partner, the local player, and he's going to sort of know the ground, and I'm going to let them control it. I'm just going to exercise my negative control, review my financial statements, and go over there to board meeting. And then people realize, well, that's not really working. People need to be more proactive, and they have become more proactive and become quite successful when they're proactive. So they often take controlling participations, which in turn, by taking controlling participations and being able to come closer to running the business, allows them to be able to sell to strategic investors without having the problem of what to do with the local player. Another thing that they have also done in cases when they have not wanted to take controlling interest is to diversify by taking minority participations with other private equity firms. I mean, I think a number of deals that I have done recently, have 4 or 5 private equity funds investing or selling out to, and often will be to a strategic player. And in some cases, I think really working because I think the problem that existed with IPOs, able to be being proactive in terms of managing the company is useful because then they have really thought about how to make the company attractive to a strategic player and really groom the company, so to speak, in order to make it attractive. I've had talks with clients, I mean, who said, well, you know, 15 years ago I was reading financial statements. Now I'm become an expert, for example, on salmon spawning in Chile, you know, on how to grow salt. I mean, I have one of my clients did extremely well by taking a Chilean salmon farm producer and turning them into a global player, and then catching the attention, I think, of a European company and selling. You know, I think they put in $30 million and sold it for 150. So, I mean, these are ways that I think they're really finding of creating value at the time that they exit. The other thing that's really happened is IPOs have now become a lot more realistic in Latin America. They, I think, continue to be problematic, you know, for Latin American countries in the United States, but in Brazil, the IPO market is booming. And it's also happened, I think, in a number of other countries. I've had clients now exit from investments, private equity clients exit from investments on the Mexican Bolsa successfully, and you know, at very favorable and attractive multiples. So I think that these are ways that that's changing. Then again, we have, of course, it's just in general a success story, but I think that, you know, people are always concerned about the clouds that may be building in the future, and at the same time that this has happened, obviously we've also seen in Latin America, I think, an increase in political risk in a number of countries, including in particular Bolivia, Ecuador, and Venezuela. I mean, obviously these are not countries that are taking up a lot of private equity capital. I mean, private equity has really been concentrating in traditionally, even back then and now, the same kind of group of countries: Mexico, Argentina, Chile, and Brazil. Colombia, I think, in particular this year and last year, has been kind of an interesting market because for private equity, because people feel assets are seriously undervalued, and there's been an increase in I think, security that didn't used to be there. But it's really the same types of countries. So. But by the same token, I think the fact that in countries like Bolivia and countries like Venezuela, I mean, the political risk has really increased. In particular, the ability, I think, to repatriate, which in Venezuela right now is pretty much non-existent, or at least, you know, extremely complex, really causes people to think a bit and wonder what could happen in the future. And I think in Mexico, there was you know, a particular close election with a candidate that was not very business-oriented that I think did concern you know, foreign investors quite a bit. Another positive thing I think that has happened is the law has changed. I mean, the legislation has improved significantly. One reason the legislation has improved significantly, but by the way, is also the rise of pension funds in Latin America as institutional players, because pension funds now have, in many countries, have been deregulated such that they can actually take participations in companies of the same size, these participations, as private equity used to take, so that they're actually partners. And as a result, I mean, the government has a vested interest in making sure that these, you know, pension funds work out. So a lot of the issues that you had legally in terms of enforceability, in terms of preemptive rights, in terms of it's a whole host of corporate law issues that before it was hard to really get changed, because I think when you want to get them changed, you say, I'm not going to change it for the gringo who's coming here and he wants to take his money out. But it's different to change it for the pension fund that everybody wants to see succeed, and at the same time it's going to benefit the private equity fund as well. All these changes, and I think you've also seen, I mean, even, you know, some of the pension funds come into partnership and become potential co-investors, I think, with private equity funds. And in some countries, they've become quite powerful in terms of, you know, being able to invest. I mean, in Colombia, in particular, they have really a right of first offer on any government privatization, which makes them, you know, sort of particularly key players and people to look forward to invest. Anyway, so that was kind of in a nutshell, I think, my description of the history of private equity in Latin America. So we're doing questions afterward, or how are we doing? Okay, thank you.
You want to go? Shall I go? Okay. Okay, well, just to start, I have to say I'm delighted to be here. I was a JD, graduated in '86. The last time I sat in this room, it was not as luxurious. It was functional. And I was sitting there, never here. So it's a nice treat to be here. And I'm really impressed with the crowd on a Friday afternoon. And I don't know that in our era we would have had this many people on a Friday afternoon. So thank you for hanging in. So I'm going to talk about investing. It's a very specific thing that I do. I briefly was a lawyer for 6 years, and then moved into finance, and I've been working in Latin America for the last 16 years in finance. I work for a hedge fund. It's kind of a dirty word these days, but it's an asset manager. We're making investments, fixed income investments in Latin America. So what I'm going to do is spend 5 minutes just talking a little bit about our business. It's not so much to advertise it as to give you a background on it, and then talk about some of the legal and other risks that we face on these and how we look at them in our transactions. Let's see if I can work this. What do I push? You know what I do to advance? Oh, it did. Okay. Okay. Let's see. Have I gone too far already? Okay, well, look, just basically, this is not so much to focus on the slides. Forum Asset Management is a hedge fund that makes investments. It's an asset manager that makes investments in Latin America. And what we are doing are privately structured lending transactions, mostly to small and middle market companies in Latin America. And we do this through a mechanism where we lend them, but we take a lot of security and collateral in the process. And we like to be very secure in the loans that we make. In doing so, we build a portfolio. I'll talk a little bit about it, a diversified portfolio across a number of countries and across a lot of different industries. And we have a very steady return. This thing returns about 12% a year. Our annualized return, I think, is 13.94%. But basically, we're trying to return about 12% a year. So it's not a private equity, shoot the moon type of return, but it's a lot better than a treasury bill, which is at 2.5% now. And it's a steady kind of, we think, relatively safe investment. Sebastian talked about there's always risk reward, and you don't get paid this for taking no risk, without a doubt. We believe we've got a better mousetrap and that we are taking less risk, but getting better reward for that. So I'll talk a little bit about, just a little bit more about the firm and how we do it. Effectively, though, we work with a team that is working on selecting deals. We have a lot of experience in doing that. We have a lot of good contacts in Latin America, which give us access to much smaller deals than the likes of Skadden Arps and Cleary, Gottlieb, and the big firms are working on. And these guys really fall off the radar screen of the larger firms. And in doing so, we work carefully on deal selection, and then work on structuring them properly in a way that we believe mitigates or manages our risk. You can never eliminate it. And then we also manage risk by keeping relatively small positions and monitoring our portfolio on an ongoing basis. And that's part of the key to the success, we believe. We do a fair amount of analysis of risk. The principals of the firm have all been working in the finance sector in Latin America. The three principals are two are from Latin America, one is from Russia, have been in the region for 30 years. I've been graduated in '86 and been working in Latin America, as I said, for, well, probably more than 15 years in finance. So we're kind of guys who've sat around for a few years and have been taking some licks and some other things, and we like to think that can help us avoid some problems going forward. This is just a kind of marketing diagram, but we look across different risks that I'll get into in a little bit more detail, and that helps us in the analysis of what deals we're willing to do and which we're not. This is just a brief description about the market opportunity. Why can we're lending at on average 15 or 16% for relatively short-term loans. You can't get that kind of return in the U.S. You often can't get that in a lot of places in Latin America. If you buy a bond from a major Latin corporation, they're going to pay you 7 or 8%, and that's a nice premium to treasuries, which are paying just a couple of percentage these days. So how do we do that? A big part of the opportunity that exists for us is simply because we are working in a sector that is very poorly penetrated. So this gives penetration of bank lending as a percentage of GDP. So if you look over here, look at a place like Argentina, 15%. In the U.S., this number is 98%, something like that. In Chile, it's 70%. If you go over to Eastern Europe, the percentages are much higher, sort of in the 30s and 40s. But in Latin America, only Chile, which was way ahead of everybody in pension reform and in changing its legal systems. Brazil is starting to creep up at 37%. But look at a place like Mexico, 16% penetration of the banking sector. So there's really, the banks are not attending a lot of people in Mexico, in Colombia, in Peru. They're just not there. They're not providers of long-term capital. The capital markets, while the pension funds have developed, are not really available to a lot of these companies because they're too small. They just don't have the kind of brand name recognition. So this is really what creates the opportunity for us in the first place. And I'm going to just skip ahead again. Let's see. Where am I pointing? Can you advance it from there? Just go ahead to the graph if you would. Yeah. This is just, again, this is a little propaganda, but this shows our returns compared to a kind of a basic bond index. So if you are a large investor and you're putting your money across a variety of different asset classes, you want to have a certain amount in equities, a certain amount in fixed income. And if you're in fixed income, your sort of benchmark is the, oh, now did I just do that? Is the, wow. Well, anyway, the benchmark is the Lehman index, and we're beating that. That's the short message of it. I'll let you control it if you don't mind. So let's go to the composition. Go back. Let's see. Well, yeah, okay. So these are the types of transactions that we do. Again, I'll talk a little bit more about them. But we have a kind of a broad split into the types of deals we do based on how we structure them. And then if you could advance. And we are very diversified by industry. We're active across Latin America and across a lot of industries. No position in our portfolio is worth more than about 5% of the total portfolio. So part of our thinking is if we have a problem with one of these and we lose half the money on it, it's not going to take away more than 2 to 3% of the returns. We're diversified oops. Okay. Okay. Well, I'll just talk. We're diversified by countries as well. We have focused principally in Mexico and Colombia for reasons that have been discussed today. The legal systems there are well developed. They're further along than they are in a lot of other places. We are not, for example, active at all in Ecuador, Bolivia, or Venezuela. Let's see. Well, we will be very carefully active in Argentina. In Argentina, we'll probably lend against offshore assets or offshore flows as opposed to onshore. And we're increasing our exposure in Brazil. That's a place where I've spent a lot of time, and I've joined with the goal of increasing that exposure. So that's just a little background on who we are and what we're doing. But let me get into a little bit on the structure of the deals and the risks. And for this, I would like to get these right. So let's see. Can you go back about 6 slides? Okay, good. So stay there for a second. Okay, so this is a very typical transaction for us. And if you've worked in structured finance for a number of years, my legal training came in help a lot. You learn to draw all these boxes and diagrams. But basically, where are we? This is Forum over here. We have various funds that are putting money into the transaction. We find a borrower, and we lend money into the borrower. But what we're looking for is a set of cash flows or a set of collateral that we can lay claim to. So in this case, the example is someone who's providing services, goods or services under a contract to to a state government or a state-owned company or another large, highly qualified, credit-worthy corporate, let's say. So we set this thing up. It takes a little bit of work. There are payment instructions to the purchaser, who's the regular borrower. These guys have a contract between them. Payment instructions are made saying, okay, we're going to set up a trust. Please make all your payments into this trust and send an acknowledgement to the trustee that you know that we are borrowing money against your contract. So then what happens if you flip to the next one? What happens on an ongoing basis is the company does whatever it has to do. It delivers widgets, or it lays pipeline, or it builds roads, or whatever the goods or services that are required. Oops. The company, the off-taker, makes payments into the trust, and then the trust pays us the scheduled principal and interest. And then the excess goes back to the borrower. So we typically have these over-collateralized. So if every payment we have is $100,000, we want to see $120,000 flowing through the trust. So that there are two things. One is we have extra coverage if something falls short, but more importantly, so that the borrower has an incentive to keep this thing going. Because if he's pledged away his entire future, he might say, you know what, I'm not going to ship these goods anymore because I'm not going to get any benefit from it. So in this case, we have what we call skin in the game. We like to think that the borrower has an incentive to keep the process going. And then we go on from there to distribute this out to our funds. These are, it's complicated as they look, they're simplified versions of what we do, but they give sort of examples. So if you could advance from there. Now, we break down the risks, and I won't go through these in excruciating detail, but the principle is these are companies that we probably wouldn't lend to, but because they are unserved and because they have some good asset or good relationship, we think there's value in lending to them. We're getting high returns on these, and we isolate the risk of the borrower by focusing really on the performance risk. We say, okay, I wouldn't lend to this borrower, but if I've got the cash flows coming into a lockbox account, if I like the payor, if I like the counterparty that's making the payments, and if I think these guys can deliver, and we do due diligence and analysis on their ability to deliver, then we'll make the transaction help. And that helps us do the transaction. We then look at the credit risk of the payor. That always has to be strong. It has to be a good counterparty who we can identify and who has agreed that the cash flows are going to come to us so that it's, you know, these things don't disappear in the middle of the night one time. And then, as I said, we focus on the performance risk of the borrower. Because of the excess cash flows coming back, these guys have an ongoing need to generate whatever the good and service, because not only are they paying their debt, but they're getting cash flow and working capital for them to continue their business. And that, again, gives us the chance to get paid and get out. We tend to do these deals on an amortizing or self-liquidating basis, which means if we lend for 24 months, the guy's paying back every month over the course of 24 months. So what that means is we are getting out of these risks. We're not sort of taking a 10-year view, lending, closing our eyes and hoping that 10 years from now the guy can refinance it. We're getting paid every month so that our risk ends pretty quickly. And because we're getting high interest rates, the return to us, the return on our capital is actually pretty quick. So the average life of our transactions is probably only 7 or 8 months, something like that, even though the tenors are probably 2 years. So it's a form of asset-based lending that works in the particular jurisdiction. Now, there are other risks, if you could flip ahead, which is relevant for this discussion. What happens if you're operating in Latin America, if you're in Mexico? What if the guy decides he's not going to pay? How do you mitigate against that risk? So we set up these trusts. We like the legal structure in Mexico and Colombia in particular because we have had experience with this. There's experience in setting up trusts, in exercising and executing collateral under trust, and in collecting under those. It was the typical case 10 years ago if you went to Mexico and you had collateral there. We talked about enforcing judgments. Even if you had a judgment, it would probably take you 7 or 8 years to enforce it. Particularly if it was some national patrimony or real estate or some fixed asset that was in the country, the courts were, first of all, not that friendly, and second of all, very slow and very inefficient. What's happened in the interim is that new kind of executive procedures have been put in place so that you can actually get collateral isolated ahead of time, transferred to a trust, and then if the need arises to take control of it, instead of going into court and fighting for it, you already have it. You already have it in the trust. You go into court and say, hey, this is mine, I'm keeping it, as opposed to, I'd like this, would you please, do you mind, and that's the thing that drags out for 8 years. So that's a significant shift in the legal landscape over the last 10 years. It's not perfect, but it's much, much better than it was, and having been in the business for a number of years, it's a huge improvement. Doesn't solve your cross-border investment in Ecuador problem, but on the sort of small scale, it's a big help. And we have had to enforce these things a couple of times. We've taken collateral. We've gone into court in Colombia, and they've recognized our rights. We've taken control of the assets and then restructured the deals, sold the assets, released them, done things like that. So we've had a good experience with that. Just a couple other things. Cross-border, you're always taking risk on the country and on the currency. If we lend in local currency, we're taking risk on that. If you lend into Argentina or Brazil or any other country, there is a history of debt moratoria. So in theory, the company could be willing to pay you, but the country could say, I'm not going to anymore. So we mitigate that risk generally speaking, we stay out of countries where we think that could happen. Venezuela is probably a prime example, unfortunately. Brazil is great these days. Chile we're not worried about. Colombia we're not worried about. Mexico we're not worried about. We'd be more cautious in the other three countries. And with regard to currency exposure, we can provide hedges through the FX market. So we may make a loan to a Mexican company that's running its business in Mexican pesos. They don't want to borrow dollars, so we'll lend to them, but then we spend 3 or 4% on a hedging program. We go to outside banks and hedge out that risk so that we have a mitigant if there's a big devaluation, or frankly, the currencies have been running the other way over the last 2 years, but it could happen. And then the last issue is kind of sovereign or systemic risks, where you worry that the sovereign is going to step in and say, I don't like this cross-border lending business, I don't want it to continue, or the banking system is getting overwhelmed or something. And that's a big part of our kind of top-down analysis. And again, we're much more comfortable these days in Mexico, Colombia, Peru, Brazil, Argentina. We're cautious, but we'll do some stuff. And again, we're going to stay away from the sort of the Chavistas for the time being, because there is a real risk that somebody could say, you know what, we're tearing up this contract. It's not going to work anymore. Okay, now if you could flip ahead to. We'll skip this one, and I apologize for all the boxes and arrows. So go to the next diagram. I just want to contrast the deal that we do, which is lending cross-border, where we're lending against the flow of dollars. So one more. One more. There we go. Okay, this is a trade transaction, and this is an example of something we're working on now. We're working with a Brazilian exporter that is in the agricultural business. So it goes and buys soy and corn and other things like that from local suppliers, and it needs money to do that. We will lend to them in dollars. They'll go out and spend the money to buy the supplies, and then they put it into inventory so that they can convert it into a finished good. They are exporting these final goods to international trading companies. So whether they're agricultural exports or manufactured exports, there's somebody offshore who's buying it and paying in dollars. So what we do is we establish an offshore collection account at an offshore bank. We make a loan to the borrower, but we have payment instructions to the trading company, and the trading company acknowledges those payment instructions and says, yes, for any goods shipped by, and under this contract, goods A, B, C, and D shipped to me, instead of paying you in your account, I will pay into this collection account, at Chase Manhattan or somewhere like that. And with that in mind, then what we're taking is the risk that the guy will perform. So if you can flip ahead. On an ongoing basis, what happens? The company takes whatever the goods are, takes the soy and crushes it, or takes the stamped metal parts and turns them into auto parts, or manufactures, does the manufacturing, and then exports to the acknowledged trading company. And then the trading company makes payment into the bank account. We take our scheduled principal and interest, distribute it to our investors, and again, the excess goes back. So we'll be looking for over-collateralization. An extra 20%, an extra 50%, something like that flowing through the account, so that there's this, again, we're covered if there's a slight, there's a crop problem or the manufacturing problem 1 month on the one hand, but also so that the borrower has a significant stake in making sure that this happens, because there's money coming back. The other thing that's interesting about this is, since this is generating dollars which are coming back into the country, it also provides a risk mitigant against the sovereign trying to interfere. So in Mexico in 1982, Brazil in 1982, they defaulted on their foreign debts. They said you can't pay any. But what they found was people who had trade loans who were generating dollars to come into the country, they exempted them from any of those moratoria. So there's a strong disincentive for the sovereign to interfere with a transaction like that. And there's a limited ability to do anything offshore. I mean, if this offshore trading company is paying to an offshore bank for the sake of an offshore investment fund, if the government of Brazil comes along and says, could you please not pay that, or says to Chase, could you please not pay that, they have no jurisdiction. They have very limited ability to interfere with that. So that's another way. There are plenty more examples, but I wanted to just give a couple of examples of how we're going into lend to relatively small companies in countries that have had a checkered past, but we're able to find through structuring these deals that we can find significant mitigants. You'll never eliminate risk, and one of these could blow up tomorrow, but part of our risk mitigant in that case is we're getting paid more quickly on the portfolio, and we have a small participation in each name. So I've come a long way from being a law student at Duke, but happy to share my thoughts on that and happy to take questions afterward. Thanks.
Well, thank you for the invitation. As Mr. Kaplan said, my name is Fernando Vaquero. I work for a law firm in Argentina. And well, the topic of this presentation is about international transactions. We tried to focus on more practice issues than legal issues. In other words, when you have to counsel a foreign investor, what are the main topics that he should know about taxation in the other country, which are these? The first one is about if the corporate income tax system that is adopted by the Latin American countries. As we will see in a minute, in general, it's more or less the same. The second point is, well, the foreign investors will do business in Latin American countries, but how? He will set up a presence in the different jurisdictions, or he will try to perform the business from abroad. The choice between these two scenarios is very significant because it changes completely the taxation of the investment. The third point is about transfer pricing. You know, transfer pricing is transactions between related parties, for example, the subsidiary and the parent company. That should be done at rams. In general, as we will see in a minute, Latin American countries has transfer pricing rules. The fourth point is about checking the box. It is if there are different legal structures that may be set up in Latin America that allow for U.S. purpose to check the box. The last 2 points is about withholding tax. It is relevant when the investment is done from abroad and is no presence set up in the local jurisdictions. And the last one are the tax treaties. As we will see in a minute, as Latin American countries do not have a very developed network of tax treaties as European countries or as US. So the first point is, although the tax systems in Latin America are really similar, they are not the same. So the third issue is not to generalize about taxes in the region and to analyze each country individually. So in this slide, we select more or less 6 countries of the region: Argentina, Brazil, Chile, Mexico, and Venezuela, and we select 6 topics. The first one is the territorial scope of the income tax. In other words, if the foreign investor decides to set up a presence in one of those countries, he would like to know if that corporation of that liability company will be taxed on worldwide income or only on territorial source income. In other words, if the company will be taxed only, for example, of Uruguayan source, or it will be taxed also on income obtained abroad from Uruguay. As you will see in the slide, in general, the countries adopted the worldwide principle. In other words, suppose that a foreign investor set up a company in Argentina and the Argentine company invests not only in Argentina, but also, for example, make a transaction in Italy. Well, the income that the Argentine company obtained in Italy, it would be taxable in Argentina and in the other countries. The second point is the tax rate. You will see that the tax rate is very similar. There are no many differences. In general, it is 35%. In Brazil, it is more complicated because they have a combination of taxes, but the final rate is more or less the same. The only exemption may be Chile, but is because they have a particular system between the taxation of the corporate income and the dividend when it is distributed to the shareholder that we will see in a minute. So the 17% rate, at the end of the day, it will be a 35%. Okay? The only exemption is Uruguay, that it has a low tax rate and adopt the source principle. The third point is the integration. The foreign investors would like to know is when set up the company and obtain the income and after paying the income tax, if the dividend is subject to withholding or not. In general, there is no withholding tax on dividend payments from Latin American companies to foreign shareholders. The exemption is, the first one is Chile, as we say, that is at a 35% withholding, and the tax paid that has been paid at corporate level is a credit against that withholding. And as we see, Mexico, Venezuela, and Argentina has imposed an equalization tax. In other words, if an Argentine corporation obtains income that was not subject to tax at corporate level, it is taxed when it is distributed as a dividend. And the same system, very similar, was adopted by Venezuela. Regarding capital gains, in general, Latin countries, they don't make any difference regarding the taxation of capital gains. They are treated as ordinary income, not subject to income tax as ordinary income. A relevant issue is about, you know, a company can go well or can go bad. So the second issue is about the losses. How the losses can be used, carry forward, carry back. Well, in general, the losses can be used only carry forward. In other words, if an Argentine company or a Mexican company suffer a loss in 2008, well, that loss can be used to offset only future income, and only future income generated in a certain period of time. Argentina 5 years, in Mexico 10, Venezuela 3, Brazil and China is indefinitely. The point of the losses that is relevant to know if that losses may be adjusted for inflation or not. Because in Latin American countries, like Argentina, where inflation is a common topic, it would not be the same value of the losses when it is generated that when it's used to set off taxable income. In Argentina, for example, we have an adjustment for inflation for taxable losses, but nowadays it's not enforced. There is a particular system that is in Brazil that although the losses can be carried forward indefinitely, they have cap. So you can use only 30%, you can absorb, you can set off with the tax losses only 13% of the income. Another issue that is general, the foreign investor wanted to know is that if the local company that they set up, if the Latin American companies have adopted any measure to prevent the double taxation. And the answer is yes. In general, the Latin American countries adopt tax credits, so any tax paid abroad can be used to offset the local tax. There is a ceiling, but in general it works fairly well. The third topic that we like to say something is about transfer pricing. As you know, transfer pricing was not a methodology that was enforced in Latin American countries up to, except from Mexico, that is the one who is leader in this issue. In general, they began to adopt Latin transfer pricing rules between the year 2000 and more or less. The legislation is very similar to the OECD transfer pricing rules, and when you approach as a tax advisor to the Latin American legislation, you will see that in general it is the same. There are certain issues that some countries adopt on some extent to simplify the tax system, that is Brazil, that use fixed margins to calculate transfer pricing, Argentina, that has a specific method to establish the transfer pricing for grains exportations, and Mexico that has no regimes about maquiladoras. This four issue that a foreign investor in general want to know is how he can check the box in the US in order to transfer the loss generated in Latin America to the US. In general, the legal system provides two types of companies, corporations or limitadas, limited liability companies. And we will see Argentina limited liability company is called SRL, and Brazil limitadas, that allows to check the box in the US. The other type of entities that are corporations, not. The next chart is focused on when the investment is made for abroad, what is made for investor, for example, as we see in the previous panelist. For example, what he was speaking about, to borrower to Mexico, to Latin American company, he would like to know if the interest or the return on the investment will be subject to withholding or not. And in general, the answer is yes, and the rate of withholding varies according to the type of the lender. In general, banks and financial entities are benefit with a reduced withholding rate than companies or hedge funds. The other question that is very common to foreign investors is if grossing up clauses are acceptable for the legislations. In other words, the grossing up clause provides that the local payer will assume the tax that should be paid by the foreign investor. In general, that type of clause are okay, and it is in general used in international financing. The second interesting point of this chart is that some countries have adopted measures against low tax jurisdictions or for funds that are being transferred from low tax jurisdictions. In that case, they impose a higher withholding rate than if the lender is not located there. The last chart is for royalties. It is a trademark or a patent that is something very common that the parent company grants the trademark to use to the local company, and we see there the withholding rates that are more or less the same. The other point is about the Latin America treaty network. In general, Latin American countries does not have a treaty network developed as European countries or US. You can ask, well, why? And maybe that between European countries the flows are symmetric. In other words, maybe it is the same cash flow that French investors made in Germany that a German investor made in France. Well, with the Latin American countries, specifically with European countries or the US, the cash flows will not be the same. In other words, European countries probably will invest more in Argentina than Argentinians will invest, I don't know, for example, in Sweden. So to some extent, to some countries, treaties are seen as only concessions or Latin American countries, that they make concessions that reduce their withholding rates, but they cannot obtain a significant benefit arising from such treaties. The other argument, well, someone says, well, that may be correct, but to sign a tax treaty will promote foreign investment. Well, that may be yes, that may be not, but there is no specific study that really prove or evidence that issue. However, in general, Latin American countries follow the OECD or the United Nations model, so when you see a tax treaty, you will not find very difficult to understand or to go further it. And we do not have, Latin American countries does not have tax treaties with US, except from Venezuela and from Mexico. In Argentina was some years ago a negotiation with the US, and it was execute a tax treaty, but it never came in force because Argentina argues that the US has to agree to include the tax-sparing provision in the treaty, and the United States says no. Tax-sparing provision means that if Argentina grants an exemption, for example, Argentina says, well, I will not tax a certain activity of certain type of income, well, such exemption should be also given by the resident country, in this case, US. Well, this is to give only an idea of the treaty network. As you will see, there are only Denmark, France, Canada has tax treaty with Brazil, Chile, Mexico, Venezuela, and Argentina. And also Spain and Sweden. So as you will see, the treaty network, the ones that is here, who has the most one is Mexico with 31. And what is the relevance to have or not a tax treaty regarding the investors, not the countries itself? Regarding investors, that internal law change significantly. In other words, withholding rates may be a near 35%, the other year may be changed to 40. Well, the tax treaty provides a ceiling for withholding rates. And in general, tax treaties or treaties in general prevails over internal law. So if investment is canalized through a treaty countries, you will have more certainty about the taxation of the investment. They will not, probably will not have is, the taxation of the investment is ruled by the internal law. This is the other point. We go now to Argentine issues, is the difference between if the foreign investor decides to set up a presence, and then the difference between the legal forms to set up a company in Argentina. That one is not. It is not to see the chart. The other point is that Sebastian said in the previous meeting, Argentina has a federal system. As it has a federal system, the national government, the province, and the lower government that are called municipalidades has power to tax. So we have 3 levels of taxations. Sometimes it's harmonized, sometimes not. So this is why the amount of taxes. In other words, some scholars say that the internal double taxation is the price of federalism. This is the other point that was said in the previous conference when you want to exit from the investment. If it is then a difference between the legal forms that you adopted, as you know, you can transfer the asset of the business, so that you can transfer the shares or the quotas of the company. Well, in certain countries, for example in Argentina, it is a difference if the company is set up as a limitada, as a corporation, or as a branch. If for an investor set up a branch, he will not transfer any shares of any quota, so he would transfer the asset, and since he transferred the asset, that would be a taxable transaction. In other cases, the transfer of shares by non-residents in some countries are exempt from tax. So that is another point that the foreign investors would like to know previous he make the company. The other point that was interesting is some IT avoidance measure regarding transfer prices that have been adopted by Latin American countries. The one is an anti-tax haven provisions. That means that if a transaction is made by an Argentine resident with a tax haven entity, it is subject to transfer pricing, either the foreign resident is related party or not. And the other that is to some extent not very common is that you have a specific method for determining the transfer pricing of agricultural or grain exportations. That is, does not follow the OECD method. This is another point that is interesting, that is one, the different type of investments of the different type when money flows out of the country, that may be interest, royalties, or dividends. Dividends we have just seen in the previous slide. The other one is investment as loans. We have, as we mentioned a minute ago, we have different withholding rates. In general, we have reduced rates from loan granted by banks or financial institutions, higher rates if the loan is granted by companies or companies located in a tax haven. And finally, this is the withholding rate for when the investment is made as royalties or as software. It is very common to see, for example, companies located in Argentina that receive transfer of technology from abroad. Well, that when the Argentine company pays the royalties to abroad, well, that will be subject to a withholding rate. And in general, these type of agreements, I mean transfer of technology agreements, trademark agreements, or patent agreements are subject to registration, not to approval. Here in Argentina, in other countries, yes, before the authorities. That has, in some countries, effect for foreign exchange issues. That means to transfer the money abroad for foreign exchange controls. And in other countries, in Argentina, for example, to obtain the deduction of the expense. And finally, the last issues regard if there is any incentives or rentings relief from taxation. There is no general incentive for taxation. There are certain exemptions or regimes for particular industries, for example, software, for example, forestry, but not at the general rules. And in general, to some extent, is an agreement between the taxpayer and the state. The taxpayer assumes in that type of regime certain obligations, for example, to have a certain number of employees or make a certain amount of investment, and the national states relief from the tax. So basically that is.
So we have some minutes for questions.
I have a question for Mr. Kingsley. You showed the very low penetration rates of commercial bankings in certain countries.
Yeah.
Aren't they taking up these type of securitizations transactions because this would help themselves maximize their lending capacity? Why aren't we seeing similar structures?
Yeah, I guess, you mean, aren't they doing the same thing we're doing?
Well, maybe not offshore, but similar kind of securitization technique.
I hope not, but I mean, for the sake of the, for the sake of the development of the countries, of course. But really what you see, we look at a place like Mexico. Mexico's banking sector is dominated by 5 large banks, 4 of which are owned by foreign companies. Citibank owns Banamex, BBVA owns Bancomer. And those banks these days are very risk averse. So they're lending a lot to the top corporates, to the, to the Cemex and to the Pemex and the, the best corporate risk. They've got big businesses in mortgages. The mortgage business has been booming in Mexico and in some consumer finance. They just haven't gotten to the small and medium companies yet, and they're probably a couple of years away from doing that. So what we find in Mexico is if we go to a small company that's growing, that has a contract, that needs to finance it, that has to buy the equipment so it can supply Pemex or it can supply the state government or something, it goes to the banks and it's, they're lucky if they can get a loan at all. It might be a short-term loan for 3 months or 6 months, and it probably will take 6 to 8 months to get the loan. So we work with local partners who go in, meet them, screen them, and by the way, the rates they're paying, if they can't get money from the banks, the rates they're paying in Mexico are probably on the order of 40 to 50% interest per annum. That's in Mexican pesos, but even in dollars, that's almost equivalent. So we work with partners there who know these companies, and then they go and say, okay, we'll finance you for 30%. So it's a much better rate for them, but we need this kind of collateral and structure and everything, and the guys are usually saying, great, I'll take it because I can't get long-term money otherwise. And then that provides the opportunity to us, and maybe we'll lend to them at 20%, something like that. So still what's happening is the reason we have a competitive advantage is we can move very quickly. The banks just aren't there. So they will be there. If you look at Chile, the participation of bank lending to GDP is 70%. There's not really a business for us there because the banks are really covering a lot of the smaller consumers and middle market companies. And the capital markets are very well developed. But Mexico, Peru, Colombia, they still have a long way to go. So, we're a hedge fund. We're just trying to get a high return for our institutional investors. But if you look at this from a development point of view, these sectors need to be unlocked for entrepreneurship to really take off in some of these countries. And, this is we're just doing a small part in that. But as more of that happens, more of these guys will grow, and then we won't make the same returns. We'll have to find somewhere else to invest.
Yes, I was interested in hearing more about the significance of family ownership and family control in Latin American businesses. As one of my research projects in the last couple of years has been the significance of family control, ongoing family control in public companies in the United States. So it's a generalization in the field that many more companies in Latin America are typified by ongoing family control. I wondered if anyone on the panel could comment on whether that's true, whether that's changing, whether companies past the IPO point continue to show characteristics of ongoing family control, and overall what you make of this as this region develops economically.
Yeah, I mean, I think certainly the, I think in the context of just my experience, there is, in the context of the private equity discussion, I think that was really the real target for some of the initial private equity investments. It continues. I don't know really what the percentages are now, but I mean, so much of the wealth in Latin America and the corporate sector was really held by families and companies, I think, in really virtually every country. I think that I wish I could see statistics on it. I don't really know, but I think there's been some development away from that. But I think that still continues to be true in most places, and for very, very substantial sectors of the economy. I think for foreign investors coming in, it was, you know, the sort of the classic kind of the golden opportunity, but was still very problematic. I think that, you know, a lot of these companies were really run essentially as fiefdoms. And, you know, you don't see a lot of the typical observance, I think, of corporate niceties and of, you know, the distinction between shareholder and the company, and that I think you may see in other places. And I think it made, you know, makes doing diligence for foreign investors, you know, especially difficult. I think that there was also, I think when foreign investors come in, particularly private equity investors, I think there was a lot of education that had to be done. And I've actually, I mean, I've worked kind of both sides of it. I don't necessarily only represent private equity. I've also represented local investors who've been receiving, you know, who've been receiving investment. And but there's a lot of education. I mean, I think a lot of people tended to view, for example, private equity as something of a bank, and expected that there would be sort of continuous funding going forward. And were very surprised when that, you know, was not the case. I think there was also a fair bit of resentment about some of the interference that has, you know, when I think investors wanted to come in and exercise some of their control rights. I think that, I think in some countries it's also, one thing that's interesting too is to look in different countries, you know, one thing is ownership and another thing is management. And I think that, I think when we think of family-owned businesses, we think of ownership and management being the same thing. And that's not always been the case. And I've seen a lot of examples. There's some interesting examples, in particular in Colombia, where even though you had family companies, there was a lot of outsourcing of management. And they tended to bring in, a lot of the large companies there tended to have professional managers brought in, especially large companies in Medellin, which was kind of the industrial center of the country, which is not really the, you know, the rule in a lot of places. So the shareholder has one last name and the manager has a different one, and really has no family relation necessarily to the owner. And I think that I've seen starting to happen, you know, I think in more places. I have also, I mean, I've seen also situations in which essentially, which is kind of interesting, in which a local family may sell out entirely to, for example, a private equity consortium, as I did on a deal, you know, a couple of years ago, and yet the family is retained to manage. That's kind of the opposite almost of what I'm talking about. Then the ownership kind of goes foreign, but, you know, people are retained because there is, you know, perceived to be value there. So I think you can see now all sorts of kind of different, you know, permutations developing, and I'm not sure where it will go, but I'm sure that you'll just see probably, you know, different varieties of that happening.
Yeah, I guess I would just add, in the 15 or 20 years I've been working in Latin America, if you go back 15 or 20 years, a lot of companies were family-owned because wealth was accumulated by families. There weren't existing functioning capital markets, so there wasn't participation of, you know, pension funds and individuals and that sort of thing. And, you know, we were financing companies 15 years ago that were family-owned companies that were really good at something, and then they were in 12 other businesses. And so when we started to try and professionalize the financing and write prospectuses and get professional institutional investors, they'd say, well, I love their, you know, their auto parts business, but I don't like their chicken parts business, and why is that in there? And so we'd go back to the families and they'd say, well, this is great, it's a diversified play, and effectively what happened is they were taking their capital and they were diversifying their holdings through companies. Whereas the model in the US and Chile and places with developed portfolios is it's diversified by portfolio. You buy an auto parts company, you buy a chicken parts company, you buy an oil company, and they have to be pure plays, so-called. So that has slowly started to change in Latin America. And I would say if you look at Brazil and Colombia in particular, where family-owned companies were diversified conglomerates, they've slowly actually started to split them into companies that are good at something. And then with that comes oftentimes professional management. But there was a philosophy for a long time of, you know, this is my company, it's not, you know, the foreign investors are here to help me, not to get value out of the company.
So my question is in regards to the private equity, there are some countries that have laws around how much percentage the foreign investor can own in the company. So for example, as far as I know in China, you cannot have a sole foreign foreign investor, he has to have a partner that belongs to the country who's Chinese. Is this the same rule? Does this exist in South America? And if it does, how does private equity go around it?
Well, it didn't. I think those laws certainly existed. I think at the beginning. I think I'd have to think right now off the top of my head where we still have percentages. There would certainly have been a feature, I think, in the past of the Latin American legal landscape, at different times. But I think you've seen a huge amount of kind of liberalization with respect to that going forward. I think to the extent that those sorts of things remain, I think you may see them more in terms of in terms of things like industries that are particularly of certain types of strategic importance, and you still see that even in the recent IPO of Ecopetrol in Colombia. It was restricted. You could only buy it if you were a Colombian. If you're a Colombian citizen, because I think, in the particular case, it was very political, sort of situation, I think originally that was something that maybe people did not care all that much about, because they were really partnering with local management anyway. So it wasn't such a problem. I think it is a much bigger problem now in terms of, I think, private equity investors being much more interested, I think, in exercising control over investments. But I think generally speaking, I think most of those laws, you don't see that many of those types of laws anymore, except in, like I said, I think in certain types of special strategic sectors and the like.
Fernando, Vaquero, to what extent do you think, or if you could tell us, the different interpretations by the local authorities change the treaties, in the international tax treaties, to that would be similar in some way?
In general, the interpretation, from the Argentine standpoint, we have two types of authorities. One is the authority who is in charge of the collection of the taxes. And we have another authority that is the Ministry of Economy that is in charge of the interpretation of the tax treaties. So, to that extent, there we have a fight between these two entities. Because in general, the tax authority, the one who is in charge of the collection of the taxes, try to interpret or to adopt the tax treaties in some ways that they want to get only the collection of the tax, and sometimes their interpretation is not so correct. The other entity, the Ministry of Economy, in general interpretate the treaties more correct, we can say.
Well, thank you very much, Gordon, Gabriel, and Fernando, for being here today. And please join us for a second coffee break and then for the third panel. Thank you.
Yeah, good to be here.